Welcome to one of the most important concepts in all of financial accounting, because this is when we start to actually keep track of what happens for the company. So when we keep track of stuff that happens, when we say stuff that happens, let me be a little bit more precise, but not too fancy. We're going to use this word transaction. So a fancy word for economic or financial event. So it's really just an economic event. Some economic event happens. As an accountant, what do? Well, we are going to analyze, or really just look at, we're going to analyze it, we're going to look at it, and we're going to consider what happened to our fundamental accounting equation. So the way that I like to do this, everyone's method is going to be a little bit different, but the way that I like to do this is I like to write out my fundamental accounting equation and then do a lot of arrows. We're going to do some arrows up, some arrows down to see what is increasing, what is decreasing as part of this particular transaction. So again, a transaction, just an economic event, and we are analyzing it. We're just looking at it, and we are trying to consider what happened to our fundamental accounting equation from that event. So what is an account? This is literally just a fancy accounting word for where we record all of our transactions that are related to a particular item during a particular period of time. So related to a particular period of time, we're showing some increases, we're showing some decreases. We're going to do that in a very specific way using T accounts, which I will talk about in the future. Don't worry about it for right now, but we'll keep track of all of those increases and decreases in each account. So the different accounts that we might deal with in accounting are like cash or accounts receivable or property, plant, and equipment, or all of our revenue accounts, all of our expense accounts. All of those are different accounts that we want to have a clear understanding of what were the increases and decreases in that particular account over a period of time. So it's the basic summary unit in accounting. So we're summarizing what happened to cash, we're summarizing what happened to accounts receivable, et cetera, et cetera. And then a chart of accounts is just going to be a list of all of them with the names that we're going to use. So for example, cash, accounts receivable, supplies, inventory, equipment, accounts payable, notes payable, common stock, service revenue, utilities expense, advertising expense. The list does go on and on. Those are just some examples there. And a chart of accounts is just, a listing of all of the different accounts that we might use. Now, we've already discussed this, but transaction analysis is really just fancy words for considering what the effect of an economic event is on that fundamental accounting equation. So we're going to look at A equals L plus SE, and we're going to do some arrows. So we're going to record this event as an increase and or a decrease in an account and see how it impacts the equation. We are going to be mapping out the equation and using arrows to do this part. But here is very important, this dual effect accounting or double entry accounting, sometimes you'll hear it called, but that sounds, I think, a little too risque. When you say double entry accounting, that seems like something that you wouldn't want to search on the internet. But dual effect accounting, each accounting transaction has at least two parts, okay? At least two parts. And the reason for that is our fundamental accounting equation must remain in balance every single time that we do one of these transaction analyses. So after each transaction, the fundamental accounting equation must always stay in balance. We're going to check this equality each time that we do our different transaction analysis with the arrows. Okay, so always do the arrows first. Later on in the class, you might have already heard about these things called debits and credits and journal entries and stuff like that. But it all is going to start with whether we do this part right. This part is going to be increases and decreases. So we're going to do it logically first. We're not going to start throwing on terminology yet. We're just going to say stuff goes up and stuff goes down. Okay, stuff goes up and stuff goes down. We are going to say that our assets must always equal our liabilities and equity, but at least two things. Okay, at least two things must be going on, because we can't just, again, I'll beat this dead horse for a second. We can't just say, oh yeah, assets went down. Assets went down. That was it. That was the only thing that happened. Assets went down. Nothing else happened, because then this is out of balance. This is out of whack. This equation is no longer balanced. So it has to at least have two things going on. Sometimes it's going to be one on either side of the equation. Sometimes it could be two things on the same side of the equation, but there always is at least two things going on for our fundamental accounting equation for a transaction. Okay, Longhorns Company pays $1,000 cash for some supplies. So let's just start. We're going to do a very, very simple example here before we get into a series of examples because really repetition and just doing this a bunch is going to be the only way that this cements into our brain. So we've got our fundamental accounting equation, and now we ask ourselves, what is happening when the company pays $1,000 cash and it gets some supplies? So on this fundamental accounting equation, I always try to look for cash first. If cash is going on, that's going to be where my focus is. And this is again where we have to be very important and very careful that we are the company. Right? We are the company. If you start trying to take the perspective of like a customer or an employee or a supplier, you're going to confuse yourself, because this fundamental accounting equation we are talking about from the company's perspective. So if the company pays $1,000 cash, assets go down, specifically cash, by $1,000. Now you can't just look at that and say, yep, we're done, because cash just going down. No, we are not done. We are not, because this is now not in balance. There's got to be at least be one other thing going on. And we paid that $1,000 cash for some supplies. So we bought some supplies. What type of account is supplies? It is also an asset. So we see that assets go up by 1,000 as well. Does this balance? The answer is yes. It's not always going to guarantee that you got it right by saying that it balances, but it's a good check, because if it doesn't balance, you definitely got it wrong. So that is going to be what we're doing here. Notice that there's no debits and credits. There's no additional terminology. We're just taking our fundamental accounting equation and we're doing some up arrows and some down arrows. That is transaction analysis in a nutshell. Moving along to do some more practice. We're going to put this into practice over and over and over and over and over again. We're going to record how these transactions affect the accounting equation. So on January 1st, Craig, and I would honestly recommend that you just pause the video now and try to do all of these on your own. So there's what, 3, 4, 5, 6. Okay. There's going to be 6 different ones that you can try out on your own. So try to put that into practice. Mess it up. You know, get messy with it. Mess it up a little bit. You know, struggle is good. So just do all of those things. Make sure that you are at least trying it out so you can see whether you're on the right track, whether you understand what's going on. Let's take a look together. After you've paused the video and tried these out on your own, we're going to say Chris's Keg Stand becomes incorporated, issues stock for $50,000 in cash. Again, I'm always going to try to look for cash first. We see that we are $50,000 in cash. That's what we, the company, are getting. Company is getting cash from owners for $50,000. And then the other thing that's going on is this has been invested by owners, right? They're issuing stock. That means that there is common stock that has been issued for that $50,000. So that goes up as well. So there we go. That is what our transaction analysis, what our arrows would be for the first one. Hopefully that makes sense. So remember, when an investment in a company is made, that increases the company's cash. There we go. That does remain in balance. So we can do that little check to make sure that nothing's amiss there. We're moving on to the next one. Okay, Keg Stand buys some supplies. The company buys these supplies with $6,000 in cash. We've really already done this one, so we're just kind of rehashing it. Let me kind of get my head out of the way a little bit so you can at least see what's going on behind there. Assets equal liabilities plus stockholders' equity. We're buying some supplies. We're paying cash for these supplies. So again, I like to look at cash first. I'm going to say cash is definitely going down by $6,000. We are paying cash. Now, what are we getting for this cash that we've just paid? We are getting some supplies, also an asset account. So supplies are going up by $6,000 as well. It's going to go onto our books for what we paid for them. Does that remain in balance? Yes. We've got assets. So notice there's only on the left side here, only on the asset side, but assets go up and down by the same amount, so we're still good. Now on March 1st, we buy even more supplies, but we buy these on account or on credit. On credit does not mean credit card. On credit means that we are just paying later. We're going to pay later. So here, there's not cash going on. So this is the first one that we haven't had to, our safety net, I like to call it, because cash is very easy to identify what's going on. So very easy to see what's going on with cash. But here, just, we're getting some supplies. So maybe that's what links into our brain first. We're getting some supplies. So there's $1,000 worth of supplies. But it's saying that we are paying for these on account. What does that mean? On account. On account means that we are going to pay later. So we have now created the liability. And that liability is going to be AP or A/P, and that is going to be accounts payable for 1,000. So AP is accounts payable. Okay, accounts payable. I want to pause here for 1 second. This confuses people a lot early on in the class, is they will just see this word on account and they will think liability immediately. Just because you see the words on account does not mean that we've got a liability going on. Okay, and what I mean by that is people are overgeneralizing. They just see this as an example where it's, oh, I saw on account in this accounts payable example, and they'll like link the two and create that as a connection or as a pattern that doesn't exist. Okay, because perspective is very important. Perspective of the company, so we the company are the ones buying on account, means that we the company are going to pay later. So this is an account to be paid. Flip that and say, okay, from the company's perspective, if customers purchase on account, that means that the customers are going to pay later. So that actually, for the company's perspective, that means that we are going to receive that money in the future. So again, you still see that word on account, but that's now from the customer's perspective. They are the ones that purchased on account. So that would create an accounts receivable for us, the company. Just wanted to point that out because people will mess that up. They'll see this on account and they just think that 100% of the time that means that there's a liability, but that is not the case. If we are purchasing, if we, the company, are the ones purchasing on account, then yes, a liability is created. Okay? A liability is created. Now, I'll take that one step further. You could also see some language where it says something like payment was made on account. Okay, payment was made on account. Cash payment was made on account. That means that we are now paying off our accounts payable. So all of that, you'll start to see this as we move through examples, as you see some tricky conceptual questions, as we get closer to an exam. But just because you see this word on account does not mean that we are dealing with a liability. Okay, be careful. Try to think a little bit more deeply. Think about the perspective of, who is doing, what entity is doing the purchasing, because all of that stuff is going to be very important. All right, that is enough of my spiel. Let's keep moving. We've got pay $400 cash for the supplies previously purchased on account. So again, here's one of those kind of scenarios. And again, like a more ambiguous, kind of trickier way that this could be phrased is payment was made on account. Payment was made on account. Okay, it might be kind of tricky there because you might say, oh, we paid for it on account originally. Yeah. Well, we purchased it on account. The purchase was made on account. But now, if payment was made, okay, payment was made means that we paid cash. So again, the terminology and you got to be very, very attentive to detail on what's going on in some of these different transactions. Okay. And a lot of times it really should say cash payment was made on account, just to let you know. But again, you see that word on account there. Doesn't mean that a liability is created because cash payment was made. That's really what we've got going on here. So let's write out our accounting equation. It says we pay $400 cash. I'm always going to look at cash first if I can, but we've got cash goes down by 400 for the supplies that were previously purchased on account. So we've already got the supplies. Those are already on our books. So it's not like we're decreasing supplies. We're not increasing supplies. These were previously purchased on account, which means that they were to be paid. They were accounts payable. Well, now that's no longer a liability. We no longer owe that money. So that means that our liabilities, our accounts payable, are going down by 400. So accounts payable going down by 400. And that remains in balance. We can move on to the next one. So Chris's keg stand buys 1,000 Kegs and Eggs Diner t-shirts. Sounds like a pretty awesome diner to go to. That's all that they serve. You can either get one full keg and an order of eggs or nothing. That's it. So you have these t-shirts that were purchased on account for 5,000 to resell to customers for more later. Let's see what's going on here. Again, I'm going to be on the lookout for cash. Is cash involved? As we buy on accounts. Okay, here again it says on account. And this is again, I'll say it one more time. You see this word on account, and this one we are actually creating liability. And so people will see two different examples back to back, and they're like, okay, that means that it's going to happen every time. No, be very careful. What is the perspective? Is it we, the company, are buying on account, or customers buying on account, whatever? Take a little bit more of a step to figure out what's going on. But here we are buying 1,000 for t-shirts for $5,000, but we are buying them on account. What are we, the company, getting? We are getting these t-shirts, and because we are going to sell them for more later, or we plan on selling them at some point in the future, that is specifically the inventory account, or the asset account that is inventory. So inventory is going up by 5,000. Sometimes people will get supplies and inventory confused. Supplies are things that we use up, that we go through. Like here at GPA Factory, we've got markers, right? We've got markers that we use as we do give these review sessions. Whereas, so these would be supplies, right? Versus if we're buying t-shirts to then resell them, those are going to be considered inventory items. So we buy these inventory items on account, which means that we create this accounts payable, we create this liability for $5,000. And this does remain in balance. So there we go. That is our transaction analysis for buying some inventory on account. Now, paying for inventory, or even purchasing it, even though we haven't paid the cash yet. Just getting the inventory on our books is not an expense yet. This is very important. We will talk about this a lot more in future videos as we get into the expense recognition principle, or at what points in time we actually record expenses. But when we first buy something that we plan on reselling, it doesn't actually become an expense yet. So it doesn't become an expense until it is sold, okay, because of that matching principle. So we're only going to record the revenue when it's sold. So really the expense that's associated with that, we're also going to record that when it's sold as well. So for right now, it's just going to go onto our books as an asset. It's not an expense yet. So sometimes people will see this and they're like, oh, for $5,000, that's an expense. It's like, nope, not yet. Not until we actually sell those inventory items. All right, the last one that we are going to do in this video just has more than a couple of different parts. So it doesn't always have to be two. It could be more than two, but it is at least two when we're dealing with this transaction analysis. So Chris's keg stand buys a piece of equipment with a fair market value of $12,000. We pay $4,000 cash and the balance by signing a notes payable. So we've got A equals L plus SE. Same kind of thing here. Now we're buying, what are we getting? We are getting this piece of equipment. So we can say increase in PP and E, or increase in equipment. Either one of those is going to be perfectly reasonable. Could be either property, plant, and equipment. Could just be equipment. You could say, depending on what kind of equipment it is, you could say like vehicle or whatever. But PP and E, it's going to go onto our books at that $12,000. Let me see. How are we paying for it? Well, it's saying we're paying $4,000 cash. Okay, I know that I said that I usually like to start with cash, but it was pretty obvious that we were getting that piece of equipment. But you could have started with cash. We're paying cash. 4,000, that's going down. And it says the balance. The balance is just the difference there. So 12 minus 4 is 8. It says the balance is going to be paid for by signing a notes payable. Remember, notes payable is just notes to be paid. So we owe that money, $8,000. So 4,000 we're paying immediately. The other 8,000 we will pay at some point in the future. So that liability is created, specifically notes payable for 8,000. It does this balance. There's more than two things going on here, but this is still just a single transaction. Here we've got overall on the left side increases by 8,000. Overall on the right side increases by 8,000. Just do that quick check with yourself just to make sure that you're not making any glaring mistakes. But that is transaction analysis. Extremely important concept. So hopefully that makes sense. We will keep layering on different concepts onto transaction analysis, but this transaction analysis honestly doesn't go away throughout the entire course. So we continue to analyze transactions. We continue to see what their effects are on our fundamental accounting equation. So very, very important concept. I would argue maybe the most important based on, just how much we are going to do this kind of thing throughout this course. So hopefully that makes a lot of sense. If you need to email me, feel free to do so, chris@gpafactory.com. You can always ask a question on the question wall as well. But I will leave you with that, and I'll see you in the next video. Thanks for watching that GPA Factory video. Hopefully that was extremely helpful. If you found it to be helpful or to kind of clarify some of that content, you can also have access to a free month of membership if you follow this link and use the code YouTube100. Now, with the GPA Factory membership, you'll have access to weekly review sessions that are 1 to 2 hours posted every single week that come with practice questions to help you along with your studies and have video solutions to those. In addition, it'll include an exam review as we get closer to the exam that'll have even more practice questions and video solutions to those given out as well. You also have 24/7 access to our question wall if you get stuck while you're studying, and you get discounts on private tutoring. So if all of that sounds great, again, go to this link and use the code YouTube100 to learn from one of the best to ever teach this course. That's me. So try it out, see if you like it, and yeah, we'll see you around. Thanks.